Apes and Apettes, welcome back to the channel for one of, if not the most exciting videos that you guys have ever seen about the AMC MOAS. Why do I say this could be the most exciting video that you have ever seen? Well, we are talking about the first effects, the first round of margin calls and the liquidity crisis that is starting for the hedge funds. Now, I realize not everybody watching this video keeps up to date with exactly what I say, and that is fine. I will give you a quick synopsis of what I have been saying over the past couple of weeks and why this is so exciting. So, if you watch somebody that has not said this before, they either don't know or they don't want to tell you this, but the markets have to come down. Hedge funds have to see margin calls and liquidity restricted to see the MOAS. You will not, I repeat, you will not see the MOAS unless you see liquidity restricted for the hedge funds. It has nothing, very little to do with what AMC price action does. We will talk about the small part of this that does revolve around AMC, but 95% of this has nothing to do with AMC. It does because that's going to cause the MOAS, but AMC doesn't directly cause the MOAS. That kind of made no sense. You'll understand by the end of this video, so I don't want to waste any of your guys' time. It is your most precious asset, so don't waste my time. Short the like button. I actually decided to keep that blooper in the video because I said short the like button. Indeed, do not short the like button. Buy the like button by making it turn blue or black, as well as make the subscribe button turn gray if you have not already. Hit that subscribe button for me. Also, make sure to get yourself some free stock. Link down below in the description. There is 3 very generous offers to you guys to get all different arrays of different valued stocks with Moomoo, Webull, and Public. You could sell those stocks and buy yourself some AMC right on that platform. It's very, very easy to do. So make sure to check that out. If you guys also want to be a part of the trading community, we called out the Facebook puts, the Snapchat calls, we called out the Ford puts last week. We're on the UVXY puts, we're on the SPY butterflies. We're doing a lot over there, and if you guys want to stay up to date with all of those moves, well outperforming the markets, check that out pinned down below in the top comment. That's not as important as getting straight into this information. So, on first glance, I want you guys to first recognize this. You would think this is almost the same chart. It's literally almost the same chart. There's a few spots that look a little different, but you will not find another chart that looks identical to these two. I mean, they're essentially the same thing. Every mark is the same. The up and down, just everything is the same, right? Now, take a wild guess what charts these are. I'll give you a couple seconds. Take a wild guess. Let me know in the comment section real quick. Now, Apple and the S&P 500, these are the same charts pretty much, right? I think it's fair to say that. They do the same exact thing. Even look at this. This move we've seen in the last couple of days. It went up a little bit, they both did, both came right back down. They move the same. And like we went over in a video, I believe a week ago, hedge funds and institutions must somewhat track the S&P 500. Now, to obviously not lose clients. If their hedge fund loses 5% and the S&P is positive 10% or 15%, they're not going to have many customers for all too long. Those customers are going to take their money out and go at least buy the S&P or buy a better performing hedge funds. So hedge funds have this pressure to maintain what the S&P at least does, and then they can branch out and go into more speculative things, then go into crypto. They can do other things, right? A hedge fund, if you guys don't know, can hold all different kinds of assets. They can hold real estate if they want to. Now, that's besides the point. So hedge funds, they buy stocks related to the S&P. So the biggest holding of hedge funds is, no surprise, Apple. But what might be a surprise to you guys is the short interest of Apple. Let's go ahead and pull this up. If you did not see the video about 1 week ago, the short interest is effectively 0.58%. Virtually nothing. The lowest levels that we have seen in a very, very long time. It's not hard also to get your hands on shares of Apple to sell short with a utilization of 0.05% and a cost to borrow max of 1.21%. So that really just blows your minds, right? If hedge funds wanted to protect their portfolios, wouldn't they short or at the very least hedge out their portfolios using the largest asset in their portfolios? That's essentially what hedging is and why it was created and why options were actually created. It's not to YOLO everything into your favorite stock. No, that's not why options were created. They were to hedge out your bet on a long stock. And that would be by buying puts on Apple or by, shorting the stock. Either way, same thing. Buying insurance. Options are insurance. Shorting is also somewhat of a means of insurance. So what's the point of this? And you could make this argument for Microsoft, for even Tesla. You can make this argument for all of the stocks that are still up on the year, right? Apple, following the S&P, is still up in the last 3 months, like 10% last time I looked. So it's doing very well. It has not seen any of the pain that we have seen. So why am I saying this? Because when the markets fall, their largest holding, their core holding, is going to drop as well. They're not protecting that. What they're doing is they are getting greedy and they are shorting the meme stocks, the retail stocks. They're shorting everything besides these big stocks. So they have already made probably a decent amount of money. Some of them. Obviously, not all of them are going to do the same things, but by and large, we're talking about hundreds of different hedge funds with short positions on AMC. By and large, they're not protecting their portfolios. They're continuing to add to their short positions on stocks that are down 70, 80, 90%. Now, news flash for everybody. And exactly why I am making this video is because stocks, when they are down 70, 80, 90%, unless you see an event like COVID, where people are going on CNBC saying the economy is going to be shut down for years and stocks are going to zero, unless you see something that justifies that level of fear, these stocks that we hold that are already down 70, 80, 90% will not get beat down as much as the broad indexes at a certain point, unless there is major fear. I mean, if Russia declared war on us or something, then sure, I mean, the markets would freak out. You could see a flash crash. Those are flash crash events, and they are really anomalies. And just look at the March 2020 chart. It was straight down, straight back up. But regardless of that, what I'm saying here is that the indexes, your Apples, which control the indexes, really Apple and Microsoft are carrying the markets on its back. So once those stocks take a hit, that's when you see all of the liquidity come to a rapid halt. That's when you see the margin calls actually happen. And when you start to see declines in Apple, nobody thinks that Apple is really going to be the stock that goes down 20%. And you can see this in the premiums, right? Take a look at March 18th, 8% out of the money puts on the SPY. 8% to break even, $389. Well, take a look at Apple for March 18th. The same exact expiration, 8% out of the money is only $187. Sure, you could make the argument that Apple is a lot cheaper than the SPY, so the SPY could go down as much, but that argument is invalid when the SPY and Apple move the same, right? So premium is a lot cheaper on Apple. Nobody expects that to take a hit, but at some point, these stocks are going to get so low, it makes no sense to short them anymore. Like, you could see, theoretically, and I've seen this before, you could see a 2 or 3% down day for Apple, and you could see AMC up. You could see SoFi, Lucid. You could see these stocks that don't really move the markets up a lot, and these bigger stocks are down. And that's the kind of situation I personally think we are headed into, especially once growth fears start to kick in. Eventually, sometime in 2022, growth fears will kick into the markets, and Apple has the most to lose since they have went up the most, right? Common sense. If you're going to sell a stock, you want to sell one you're at least up on, and Apple is not bulletproof. People don't have to go out and buy the new phone. They don't have to go out and buy the new MacBook or, iPad. they don't have to. And that's eventually what the markets are going to realize here, probably in the next month or two, honestly, once you start to see more economic data coming out. And that's when you're really going to see the margin calls and the liquidity crisis hit the fan. Now, if Russia does invade Ukraine and the markets take a sharp drop down, you could see margin calls. But what I really think is you're going to see a slow decline in the stock market. You're going to see up and downs, but you're going to see the market selling off, and the hedge funds, they will continue to beat down stocks that are already beaten down. They will not protect their portfolios for any losses they will occur during the actual rapid descending of stocks like Apple and Microsoft. Eventually, it will happen, and eventually the margin calls and liquidity crisis will start on a massive scale. Now, I want to point this out. The January, obviously last month, margin data just came out. The margin debt was at $829 billion. December, it was at $910 billion. Well, let me put something very clear for everybody. This margin debt was really retail margin debt that came out. The difference between 829 and 910, what is that? Like $90 billion? That was mostly retail. Or people maybe like Cathie Wood, the funds that follow Cathie that are down 50, 60%. Not a majority, a very, very small majority of funds this would apply to, right? Because if you're weighted in Apple and you're shorting the small caps, you've done exceptionally well. You've done very well for yourself, right? So you really haven't seen the margin crisis actually start in a substantial way. You're seeing the beginnings of a very irrational, greedy hedge fund monopoly, if you will, across the broad markets, and the behaviors that they are doing that is really going to hurt them a lot when the markets do actually come down. And you're starting to see the margin debt going down, but it's not the institutional or the hedge fund margin debt by and large. Sure, you have some hedge funds here and there that are getting rid of their margin debt, but by and large, they're not. A lot of this is retail margin debt, with a lot of your, even good stocks are down a lot. Even Facebook, I don't think that's a great stock. Don't get me wrong. They do make a lot of money, and they're down like 45% now. Crazy. You got all of your small cap stocks, right? They're all everything is beaten down besides Apple and Microsoft, right? Pretty much everything else. Nvidia, Tesla, they're all down substantially. So it's coming down to those two stocks, the largest holdings in hedge funds portfolios. Now, what is likely to happen? How is this sequence of events going to affect AMC? Because like I said in the beginning of this video, AMC moving up or down has very little to do with shorts covering. It's this situation, like we just went over, how liquidity will be restricted and margin calls will start, but it's at that moment when the stock price of AMC goes up that shorts start to lose out, because they're continuously piling onto their short positions. So you got to imagine, if they short the stock at 15, now it goes up to 17 and Apple's down 3 or 4% in a day. You're going to see a massive beating in your portfolio, to say the least, on that given day. Now, I think that will continue to act that way as, the indexes come down, as large cap stocks like Apple kind of flatten out and trend downwards, whereas the small hedge funds in AMC, they start to get margin called. The big guys start to get margin called. Whole time, funds are selling Apple and Microsoft to cover on those short positions, because very little people are keeping cash. We could see right here, $941 billion of essentially cash. Last month was $215 billion of cash. So they're really not keeping cash right now. They're parking their money in stocks like Apple. So it takes money from there to cover on their AMC short positions. But I think the best part about all of this is you're not hoping for a flash crash and you have a 1 or 2 week period to see the MOAS. That's not the case. This is going to be a downward trajectory until the Fed U-turns, which is not going to be for a very long time. So all in all, very exciting, and I hope you guys are just as excited. And I like to make these weekend videos going over my logic, how things have changed and evolved, because things change on a daily basis, and I like to keep you guys up to date with exactly what is going on and where my thought process stands. If this trade were to fall apart, I would be the first to let you guys know. That is why you want to subscribe to the channel and hit the like button. But things, every day I look at them, are getting better and better and better. So that's the scoop as far as that. As far as AMC's actual short interest, let's go ahead and pull that up just for, the fun of it at this point. We can see the short interest is sitting at 21.13%. Like I said, the short interest change was positive 0.76% for the day. Shorted shares at 108.44 million shares. Cost to borrow max at 2.73%. And still, people that do hold AMC long, like BlackRock, Vanguard, Renaissance Technology, that have over 5% ownership in AMC, don't want to lend it out for 2.73%. Who would want to do that? That don't even cover inflation, not even close. So that's at 100%. Days to cover at 2.37. So every metric that you are looking at on the Ortex data, the margin debt, what is going on in the broad markets, I've never been more bullish on AMC, and I think we're closer, obviously. Don't quote me on this one. I think we're closer than we have ever been to seeing the MOAS. Obviously, every day, I get it. Every day we go on without seeing the MOAS, we're closer to the MOAS, right? I get that. But it's looking very, very good. And now, regardless of that, we have the manipulation that is coming to an end, right? Or at an end. You see AMC. The stock of AMC is now able to do its own thing. It's able to do its own thing. Right? You've seen the stock rallying as the SPY has actually been going down. And the SPY, if you don't know, stands for the S&P 500. So what do you see right here? SPY has been trending downwards since really February 9th. The past 10 days or so, it's been trending downwards. What has AMC been doing since February 9th? Trending upwards. Interesting. So the manipulation is pretty much gone. I will make that claim. We see the probe, and Citadel was actually named in this probe now, that really started in 2019 according to authorities, and it revolves around all liquidity providers, but the big guys have been named, like Goldman Sachs, which you see right here, the second largest market maker, Citadel, JP Morgan, Goldman Sachs, all these guys, or Morgan Stanley, they have all been listed in this probe, and they have been the ones manipulating the stock for their own gain and keeping it down. So when you add all of this together, there's a lot to be bullish about. And ultimately, the more fear you see in the markets, the better things will get, and the closer we are. So that's basically my take. I don't want to make this video all too long. I wanted to give you guys the gist of why I am personally so excited with the data that I am seeing. And just honestly, take a look at these charts. It's like the massive domino, right? You have the domino effect that happens, but then you have the domino. Like the one domino is Apple. Once that motherfucker goes, everybody's losing out. Everybody. Hedge fund, they're done. They're done. So that's the gist. If you guys found value or entertainment, you learned something, hit the like button for me. Don't short the like button. Subscribe to the channel as well. Make sure to check out the links down below in the description of this video, like I said, as well as the link for the trading community. We are doing all kinds of things, hedging out our portfolios, making a ton of money. I mean, the Facebook puts $60 into $3,000 per contract. I did have 5 contracts. Other people had a couple as well. So if you guys want to be a part of that, check that out. We are killing it over there. Enough said about that. You guys enjoy the rest of your day, and I will see you in the next one.